Not only is it the end of the month, but also the end of the second quarter. What does that mean for macroeconomic data releases and geopolitical risks? Let's find out with Bob Mason of FX Empire. This is your midweek market drivers. Hello, Bob. Good to see you again. Thank you once again for joining us. Not only is it the end of the month, but it's also the end of the second quarter. What have been the highlights so far?
Well, the highlights, you really got to be looking at how the markets are battling. You got constant support from the likes of the Fed that's propping up the equity markets. We saw the equity markets see their best quarter since 1987, the US markets, and the European markets since 2005, sorry. So, that's quite impressive when you're considering the state of the global economy. So there's a lot of support from central banks and obviously government. So that's the highlight. The reality is obviously that we're seeing this continued upward trend in COVID-19, new cases and spikes that's leading to this pause in the US in particular. The good news for Europe, however, and the EU is, they're removing the ban on non-essential travel today, so borders reopening, and the numbers out of the EU hasn't been particularly dire in terms of new cases. So that's a positive. So who should be really outperforming at the moment? You'd think the European markets should be playing catch up by now, the equity markets, and outgunning the US majors when you consider the fact that COVID-19 remains a major hindrance on the US economy while the EU continue to open up and rebound from the meltdown.
So an overdoing of stimulus could cause uncontrolled government debt that has never been seen before. But what about macroeconomic data? How are they looking for this week?
On the economic data front, for the EU, you've got, I would say, service sector PMI numbers due out on Friday, and today's German unemployment numbers and retail sales figures. Those are really key. For the US, we saw consumer confidence bounce again, on Tuesday for June. So on Thursday, you got non-farm payrolls and the weekly jobless claims. There must be an improvement in labour market conditions to support this market sentiment of an economic recovery. If the NFP numbers disappoint, and we'll get a taste of what's to come on Wednesday's ADP non-farm employment change figures, if these are dire numbers, then the markets really need to reconsider what lies ahead. Yeah, the Fed's going to keep chucking money in, equity markets can, do what they're doing, but it's unsustainable. So, let's see what this week's figures have in store. And then, next week we're going to have the non-manufacturing ISM numbers for June out of the US, and that's going to be particularly key as well. It's all about service sector activity right now. Labour market conditions need to improve. That drives consumption, that drives service sector activity, and then we should see manufacturing sector recover as well. We need to see that, however.
And lastly, to finish up on geopolitical risks, with Brexit and the trade war agreement bubbling and simmering to the surface, what can you add to that?
On the geopolitical risk front, well, you've still got Brexit. UK, there's now some discussion about whether, it's actually worth the UK drawing out a trade agreement with the EU with all the bells and whistles the EU are looking for to show their strength and to prevent the likes of Italy from ditching the euro. The jury's out on that one, but let's face it, Boris Johnson's not going to buckle. British negotiators know exactly what they're going to do, and the Tory party is majority pro-Brexit. So there's no compromising here from a British party perspective. So negotiations are going to be tough, and they may go nowhere. But let's not forget, it could be better for the British people and the economy, and not a negative if there's a no deal. So the pound's held fairly steady when you consider the chances of a hard Brexit, rising by the day. Elsewhere, trade war, you got US threatening tariffs on obviously the EU, and then you got US and China. These are all simmering in the background, so it could prop up at any time. When you consider the fact that the US president is languishing behind Joe Biden in the polls, and really, one mistake after the other, he's going to have to do some more distraction to really, try and rebound and have a chance of winning his second term. At the moment, it's not looking particularly good.
Okay, Bob, well, that's all for today. Thank you so much for joining us today, and I'll see you again next time. That was your midweek market drivers. In the meantime, to keep up with all the latest information, please don't forget to follow us on all our social media outlets.